ChatGPT Plus is free for college students through May. Here's the thing. You've got a lot to do between now and then. Studying for finals, writing papers, trying to keep your life on track. And ChatGPT can help with all of it. It can quiz you for your econ exam, make a study guide from your French notes, plan out your meals and study breaks. It can get really specific on how you like to learn. It can even help you come up with ways to stop procrastinating. So from now until summer break, take advantage of all the ways ChatGPT can make your life easier. Restrictions apply.
Shopping is hard.
I can never find anything in my size.
I don't even know my size.
I buy my clothes the same place I buy my groceries.
There's a better way. Make it easy with Stitch Fix. Just share your size, style, budget, and done. Your personal stylist sends pieces picked just for you.
That was easy.
Stitch Fix. Online personal styling for everyone. Free shipping and returns. No subscription required. Get started today at stitchfix.com.
Before we begin, I'd like to share a few words from our sponsor, Arbonix. Thank you, Arbonix, for sponsoring Reversing Climate Change. You help make this show possible. I'm so grateful to you, and you deserve it. I don't like taking sponsorship from people whose companies I just don't believe or I don't want to work with. And thankfully, I don't have to, because there are companies like Arbonix who are willing to come and support Reversing Climate Change. If you don't know about them, they're doing amazing forestry projects in the Baltic states in Europe. Europe has over 14 million hectares of underused land. A lot of it's abandoned or low quality. Not a lot is happening on it. It used to be forest, but it was cleared for farming as farming intensified. And then a lot of that farmland was later abandoned as the global food system moved towards lower cost producers. The land just wasn't worth tending, and certainly not tending in a way that we would respect as regenerative and carbon sequestering process. It was just underutilized, maybe unloved. Arbonix uses technology to help landowners even find this land, and once they do have it, how to restore it back into carbon-removing, biodiverse forest. If you care about carbon being removed and you want to see Europe return to the forested continent that it once was, you should be looking at Arbonix. Go talk to them. I had Lizette Luick, their founder, on the podcast. The link is in the show notes if you'd like to listen to it. We talk about a lot of the tricky issues that surround durability and carbon removal and how does forestry fit in. It's a very thoughtful episode. I really liked talking to her. It made it really easy to pitch Arbonix on doing some business together because I want to see their work be successful, restoring biodiversity and making forestry, especially good forestry, profitable again. Man, that is a game changer and so important if you can pull it off. Thank you again, Arbonix. The link to check out Arbonix's website is in the show notes. You should listen to the show if you haven't heard it already that I do with Lizette. It will teach you quite a lot about how they think and what they're doing. And now we will feed back in to the rest of the show. So thank you for listening. Here it is. Hello and welcome to the Reversing Climate Change podcast. I'm Ross Kenyon. I'm a longtime carbon removal and climate tech entrepreneur. I'm going to introduce my guest. There haven't been that many exits in carbon removal, and Jim McDermott's thumbprint rests upon several of them. Before I get into Jim's background, if I could just ask you, please become a paid subscriber to the show. It's $5 a month, gets you ad-free listening. You can do it through Spotify. It's really convenient. There's bonus content, and it helps make the show sustainable, which is very important. I'm sure to you listening, you want the show to continue. That's how you help. Thank you so much for doing so. If you can't afford to do that right now, but you still want to show your support, a great rating, 5 stars on Apple Podcasts, as well as a review. Very important. And also on Spotify. You can only do ratings there, but 5-star rating on Spotify, hugely helpful. Thank you. And in any case, let me tell you now a little bit more about Jim. There's so much to say about Jim. We don't even talk about it on this show, but I remember seeing his company's commercials on TV all the time when I was a kid. He's the founder and CEO of Stamps.com. Do you remember Stamps.com? I have such a clear memory of the commercials airing on TV. That was Jim. Very cool. And from there, he made his way into private equity and the energy business. And just going through his LinkedIn, his background is deep. He is involved in many companies. He sits on the board of many companies that he invests in. He's seen some big deals. He was on the board of Carbon Engineering, which was sold to Occidental Petroleum, which we talk about. In the episode, we refer to it as Oxy. He was also the founder, CEO, and board member of 1.5, which also sold to Oxy. He founded Avnos, which is a big direct air capture company that also produces water. Carbon Ridge, I don't know if you've been seeing what's happening with decarbonizing maritime vessels. So much of it takes place inside of his company, Rusheen Capital Management, LLC. Rusheen invests in these companies, but it's also involved in identifying early talent and proofing out some of the ideas, and just, it's almost like a little incubator or a little venture studio. It's higher touch than a lot of what you see elsewhere in venture. We talk about what it's like to exit several companies in carbon removal and to be involved in those processes. There's not actually that many examples of companies that have exited. One of the other big deals that just happened was Holocene, also sold to Oxy. And if you're sensing a pattern here, the specific pattern is that Oxy is buying direct air capture companies. The other pattern is that oil and gas companies will likely be the exit route for at least some sets of companies within carbon removal. This is a trend to keep your eye on. It depends on how you view it too. This could be a really great thing because it allows the industry to run things in reverse. If you're skeptical of it, it's because they are greenwashing and you shouldn't trust them at all. I will leave it up to you to make up your mind on that. So Jim has a lot of experience here. He has great advice for companies that are project developers within carbon removal who are facing turbulent times. Listen to Jim. I hope you enjoy. Thank you so much for your time. And here is your show. I'm happy to have you here. You have the distinction of having 2 full exits in carbon removal, which, is there anyone else that has that record? Is there anyone else that can rival your status in that way?
I don't know. We don't spend a ton of time reading about it, but I think it's fairly unusual. Well, I'll put it to you this way. No one's ever told me that they've sold 2 businesses in carbon removal. The guys at Holocene just had an exit, so Keaton has got one under his belt, but I think, and I'm super excited for him. But I think at this point, 2 is the limit.
Keaton's coming for you, I think. Yeah. He's going to take you down, Jim.
That's I look forward to that. I very much look forward to that.
What's the process like of exiting a company in climate tech or carbon removal? It's fairly rare, as we've mentioned, and I think everyone is looking forward to what their company statuses will be like in this new administration and the future beyond it. What's it even like to set a company up for acquisition like that?
I don't think it's all that different from any company that you're building, irrespective of climate or any other business. It's fundamentally being able to position the company in a way that buyer believes that ultimately under their tutelage or ownership, things are going to continue to grow. And I think that probably the biggest difference is because climate is emerging, there aren't as many sort of established cash flow stories as you likely see in other markets. So a big part of understanding and when something acquires it is kind of what's the cost of capital and what is that technology development cycle look, from today forward. And I think so you have to spend a lot of time really thinking about how you're going to drive down cost and how that's going to impact the overall growth of the business, because there's still a lot of cost reductions required in these markets. So successful acquisitions usually are predicated on a lot of development to date, followed by a real credible story on how cost is going to get reduced over time.
With regard to Oxy, who bought 1.5 and Carbon Engineering, at least partially from you, and then also Holocene, what goes into an M&A, a mergers and acquisitions strategy for an oil and gas major? How do they decide of all the companies in direct air capture that they want these particular ones? How does that process even work? I think only once you get to a certain level of success as an entrepreneur do you even face that decision.
So I think that the way that successful oil and gas companies are prosecuting it is that they're first taking a very broad look at the landscape with respect to which technologies they think are most likely to work and which technologies are most likely to work in the regions and areas and climates in which they operate. So if you're, say, a Canadian oil and gas company, you have a different set of criteria for where you might put a DAC plant in Canada because the operating environment is different than, say, if you're only in the Permian Basin. So I think what you see is the good companies do a very judicious look at all of the available technologies, and then they usually select one. In the case of Occidental, I think that they've been clear, and Vicky has said, that they believe in a liquid-based sorbent approach. There are solid sorbents, there are moisture-swing sorbents, there are electrochemical processes. So they make their own decision about which one they think is most likely to operate well and within the context of their operating envelope. Then I think once they make a platform acquisition, what you then see is a lot of focus on process flows and breaking down those process flows to see where individual technologies can be purchased to increase the efficacy or the cost reduction across the supply chain. And frankly, that's what, if you look at Holocene, that's very clear that's what Occidental did. Is that they said, look, we have a liquid sorbent approach, and we're pursuing it, we're driving costs out of it. The technical approach that Holocene was utilizing, I believe that Oxy believes that will help drive down their total cost of carbon capture, and that's why they did it. So you see acquisitions first at platform level, then followed by tuck-in acquisitions that drive particular pieces of their system level engineering.
Does this surprise you that we haven't seen more acquisition deals at this stage of maturity for carbon removal?
No, actually, I believe that there will, but that said, I believe that there's going to be a huge wave of them coming, I'd say late 26, 27, 28. And that's because when you look at the progression of the technology readiness or the TRL levels of the guys who actually have money who are progressing through, most of them are going to be in a situation that around late 26, early 27, 28, they're going to have commercial level products ready to go. And I believe a bunch of oil and gas and frankly, large manufacturing players are going to start buying things. So it's just that they're not quite there yet.
I'm wondering how many carbon removal companies might be able to make it that long. I think if they have big offtakes that are able to be financed, they'll be okay. But the buying environment by then could be very different.
I think that one of the major questions that every board and every CEO that's in the director of capture business is asking themselves right now is, do I have enough money on my balance sheet today to get out to the 26, 27 timeframe? And I will tell you, Ross, I have very high conviction that I think we were keeping track of somewhere north of 150 companies had been funded in DAC. I think that the die-off rate between here and 26 is probably 80 to 85%. I think a lot of companies are going under. And that's part of the natural venture capital cycle where a lot of things fail. It's being really exacerbated, I think, by a lot of the chilling effect right now in the U.S. on, from a political level. I think a lot of people are looking at it and saying, look, if this isn't working right now, or I don't have ample capital to get myself through the next 24 months, maybe I'm just not going to get any more money. Which is, I think, for people who are focused on which technologies they care about, maybe a terrific buying opportunity for folks on one side of the equation. And on the other side, it may be a situation where stuff that was working is just not going to happen. It's going to die on the bottom.
Sounds like a lot of the die-off rate is just a response to macroeconomic conditions that are beyond the control of these individual technology developers. They might have great technology. They might not have an offtake in hand or be able to survive. And that puts them in a very dependent position. And it almost seems very unfair to be at the whims of such global world historical moments that maybe are responsible for your business success or failure. It feels like a lot of this is luck or timing in a way that people that are successful entrepreneurs sometimes highlight that luck played a big role in their success. I think we're seeing that a little bit now here too.
Without question. I mean, I think it is look, any startup can be a fearful situation because you're trying something that's brand new, you're creating something that's never been done before. I think that there will be plenty of people in this sector who, in retrospect, had great technology and just got treated unfairly because of the whims of their capital markets. And then there will be some folks who survive and make it through with maybe not the best technology and ultimately get to an exit or becomes part of a larger entity. I think, having been in business since the early 2000s, I watched this cycle in software where, over and over again, people with inferior technology solutions won because they either got themselves into a large, well-capitalized company or that they had better financial backing. So again, I don't think this is something that's discrete or focused on climate. I think it's just the way that the natural thing works. And good entrepreneurs, I think, recognize those cycles, prepare themselves for the ups and downs that invariably come. And so I think it's both luck, but it's also skill, in the sense that one of my favorite questions is business early when my dad used to ask kids, just because you're paranoid doesn't mean they're not out to get you. and running paranoid in climate about the fact that the capital allocation swings can be pretty severe is the hallmark of a good entrepreneur.
If they have to stay alive until second half of 2026 for some of these deals, or maybe even beyond that, I imagine they're going to be cutting costs, going into cockroach mode, just trying to stay alive. And the old line for this is that companies don't get sold, they get bought, right? And I imagine it's going to be a buyer's market if you expect 80 to 85% of companies to fold under themselves. That sounds like a buyer's market to me.
I think it's a buyer's market, maybe. And here's why. Because there aren't that many energy companies to buy. So, let's say, as a thought exercise, out of 150, let's say 20% survive, right? So you got 30 companies that come out the other side, 20 to 30 companies, right? Well, there's only, 15 or 20 major oil and gas companies globally. And if they're all going to want to own their own technology and they're all going to want to control their own destiny, if you've got one of the better answers, I actually think you're going to, all you really need is two people to compete if there's if acquisition is sort of in the offing. So I'm not totally sure that I think it might be a buyer's market if you're not one of the winners. But I think if you're one of the winners, it feels a lot like a winner take most situation to me for the folks who make it out into the 26, 27 time frame.
Do you have any advice for companies that might hear this podcast, be concerned with these predictions, and want to set themselves up for future success for acquisition?
Couple pieces of advice. The first thing is, we've seen this. We saw this a lot last year. There are times in markets where raising capital, like the definitions of success, is don't move backward. There were a lot of companies that we saw last year that were like, well, I had a huge step up in the last round and I deserve a huge step up now. And the answer, I think, to a lot of people is that you should take money to survive sometimes. And I think we're in an environment like that. We're just, doing a flat round. It's not a bad thing because it means you're going to be around when a lot of other people don't make it across the chasm. That's one. And two is, I think, define very carefully how you're sort of chunking through your milestones, and make sure that the milestones that you've defined for yourself are ones that people outside of your company care about. Right? Because we have seen over and over again situations where people sort of define metrics and then they hit them and then they say, well, but no one cares. And you're like, well, that's because you didn't ask anyone, right? So I think it's, if you're thinking about, oh, well, maybe this is ultimately going to end up in the hands of someone who's sort of further up the food chain from me, then it behooves you to spend some time thinking about what's their process, how do they think about things, and don't try to overlay your preconceived notions about what value is. Well, go listen to the buyers. And very concretely, large oil and gas companies operate on stage gates. And it behooves you to go learn how they run their stage gate processes.
Can you tell us a little bit more about how that works? I imagine that's a new term for many people listening.
Stage gate is really just a process when you're doing a very large engineering project that basically you set up a series of milestones. And then when you get to that staging gate, you sit down as a group and you look at all of the various things that, generally speaking, it's commercial, technical, regulatory, and financial. And you say, have we reached the defined stage gate to move beyond this? So one of the stage gates that you offer now is just basically, do you have a commercially viable price for what you're about to do, right? The second one often is, can you get it financed, right? So oftentimes, when you reach a stage gate, and oftentimes what happens is you move through a stage gate is they start with, say, what's the pricing on the project? And the first stage gate is plus or minus 50%. The second stage gate will be plus or minus 25%. And the third one is plus or minus 10. And so when you move through stage gates, and every corporation has their own stage gate process. So if you're thinking about how am I going to fit into an acquirer's potential, business process, educating yourself on stage gates is really important.
With regard to flat and down rounds, do you think entrepreneurs and founders should feel the amount of shame that they typically feel around those events? I know it's good to stay alive, but oftentimes they don't get announced as loudly as maybe they should. Even just staying alive, though, is a success, especially in a volatile, strange market that is still very undefined like ours is.
Oh yeah, no, I don't think that, particularly hardware markets, because so much of hardware can be driven, the cost of the hardware when you deliver the hardware, because supply chains are global. There's a lot of, there's currency movements, there's tariffs, there's all sorts of things that are sort of exogenous to your activities that can make your life hard. So I think what we try to counsel everybody that we work with is like, just be conservative in terms of how much money and how much time you think it's going to take, because you can't really control, like for instance, you can't control, say that, the Trump administration decides they're going to put 145% tariff on something. It's not within your control. What is within your control is to anticipate that there might be a significant price increase while you're trying to build your first unit. Right now, can you pick 145? No, but you could make the assumption that, hey, in a reasonable market or in a low turbulent market or low volatility market, it's going to be $100 to build something, and plan for it might be 125, right? But no, I don't. Shame is. Shame is I think that's sort of the valueless emotion, what involves clean tech, which is there are just so many moving parts that you just need to stay focused on, like, what can I control, what can I not control, and how do I keep moving forward?
One of the long-running jokes as a founder is that, when times are good, you're bored and VC's backing you will say, we don't care about profitability, just grow as fast as you can. And then exogenous forces will bear down upon you. Interest rates will change and they'll say, cut expenses. It's all about profitability. Like, how fast can you make this work? And getting jolted around like that is a very common experience. It is out of your control, and that you might try to be expanding as fast as possible, then get caught out and then almost get in trouble for doing so. I think it's really tough to be in a spot like that.
I agreed. But that's, I agree that happens. I don't agree that that's necessarily good board management or people acting the way that they should. Because when you get into a climate investment, and talked about this in the past, one of the things that you really have to do is understand that you're involved in a very long time horizon game. This is not, I've taken $1 million and I get a product on the internet on AWS and and it's up there running and someone wants to acquire it in 18 months. Like, it's just not a thing. And so when you invest in a climate or hardware play, you need to have your head around maybe 7 to 10 years. And during the 7 to 10 year period, it's almost a guarantee that there will be one or two cycles as you've described, right? And so the idea that all of a sudden everything is moving the other direction while you're trying to prosecute a 7 to 10 year plan is not realistic. And insofar as your board or your investors are sort of all of a sudden waking up to that, that's as much on them as it is on the entrepreneur.
Rusheen has an interesting business model to me. It seems like you have founded or co-founded several companies. It almost seems like you incubate talent and then you send off these young, or not always so young, entrepreneurs off on their own company journeys here. How do you think about this? Why do you do it in this way? It strikes me as somewhat unusual. Maybe it's not, but why do business in this way?
Three reasons. First one is that Jeff and I met as entrepreneurs. I always say, that people used to ask me, what do you do? I say, well, I'm an entrepreneur. I'm an operator with money. I'm not a venture capitalist. I come from the operating side, and I firmly believe that operating and good operators are the people who drive things. Money is not, money is it's necessary, but insufficient. So I think you start from the operator side. And the second reason we do this is that in looking back at all of the investments we made at USRG, which was the first private equity firm that I had, one of the things that emerged was that almost in every case where we'd done really well, we'd been involved very early. Sometimes we'd come up with the idea ourselves. Other times, founder to come in and we'd work with them sort of from inception. And so looking back on Jack and I's track record, it became apparent that we're better early stage people than we are late stage project guys. Now, I know how to do project financing, but I realized in my 50s that I should focus on what I'm good at doing, which is starting those things. And the third thing is that having built a publicly traded software company early in my career, and having been in the energy business the rest of the time, the amount of attention and time that's required to incubate a hardware company or something that is in the, we'll call it the climate space, relative to a software company, it's orders of magnitude more. So you can't have like a spray and pray, which is to, put 150 investments out and then just start seeing the chain survive, which does work in software. I mean, look at 5 minute startups, a lot of guys have done that. That does not work in hardware. And so our model is go in early, do a few things, and then work very hard on them until they start to really catch, get air under their wings, or whatever analogy you want to use. And then after that, we tend to back off and don't play such an activist role. But it means that we can only do 2 or 3 things a year, but we really focus on them. Which means I'm not running a $10 billion fund because I can't. My operating leverage is putting out 150 bets a year is not. It's just not. We have not found that it works.
Does your experience lead you to think that the capital allocation model for climate tech and carbon removal is also insufficient in some way? This maybe isn't purely idiosyncratic to you personally. Maybe it's a sign of a larger dysfunction or inappropriate application.
Yeah, absolutely. Perhaps there's a perfect segue. One of the things that we have found at Rusheen, and that I'm hoping with the world will come around to, but at least my view on this, is that there's probably a better capital model than a 2 and 20 closed-end 10-year fund for climate. And the reason that that's the case is that most investments take much longer than a typical software or life sciences, maybe some life sciences work, but they tend to be 7 to 10 years. Every really successful outcome we've had has been at least 7 years found in the making, which is a long way. I mean, it's an example, carbon engineering was started in 2009 and the exit was in 2021.
Wow.
Right? So then that's the biggest, and there were many years where David and the guys were, and in fact, they were backed by Bill Gates, who really has no time horizon if you stop and think about it. And what that allows him to do, or people like him, right? So the fundamental problem is that the 2 and 20 structure requires you to turn the money so quickly that oftentimes you exit when the slope of the curve is still pretty steep, or you end up trying to do things to make the slope of the curve, the value curve, steep, that are really suboptimal for the long-term outcome of a company. And so I think a much better model would be a form of a perpetual capital model, where you basically take in capital and you invest it, and you don't really have a time horizon other than as long as the company is continuing to build and grow and create enterprise value, you just stay with it.
Why did venture capital end up in the 10-year closed fund model as the Schelling point? Like, surely there's other ways of doing things, but it's just the default for everyone. Why?
Yeah, I'll tell you why. So the history of venture capital is largely a history of Silicon Valley, right? And venture capital is very, very good for a software model. And the reason is it's asset light. You don't need a lot of capital assets to do what you're going to do. And you can be very efficient with the mod. And the marginal distribution cost of the next unit is 0. I.e., I put it on AWS on the internet and I serve it up and there's more likes, more, CPMs, all the rest of that. So that model has been, by and large, where people make the most money over the last 25 years. So, and what does venture capital like? Venture capital likes large TAM and markets. They like high growth, and they like, big demand, right? So when you look at energy or energy transition, prima facie, it looks like it's all of those things. It's a really big end market, really critical, everybody's got to have it. The problem with it is that it's largely infrastructure based. Right? It involves changing infrastructure, it involves hardware. And so when the idea to start to invest in that started to emerge, all of the very large capital allocators, the CalPERS, the CalSTRS, others, looked to their most successful venture managers and said, could you, like, I loved being in Kleiner 5, I did really well. I was in Benchmark, I killed it. So, hey guys, we want some energy exposure. And my managers, being who they are, they were like, so you want to give me a bunch of money that I can go manage? And so they did that. And the problem with that was that many of the people who came into the first couple waves and continue to do this have a fundamental orientation towards software, which is anathema to how you prosecute a hardware business, much less an infrastructure business. And so you got a lot of people raising money. They've told their LPs that something's going to happen. And the LPs have been acclimatized to the idea of short time frames because of software. So when they don't see that in energy, they start to think, oh, well, maybe it isn't working. So what does the GP do? They kind of try to speed up the cycle. And boom, you get a mismatch. You get a mismatch in how the growth should really occur versus what's been advertised.
Have you had much success speaking with co-investors or potential co-investors and LPs in trying to reframe how they should be approaching climate investments? Like, are you able to pull them out of that way of seeing things?
In certain instances, yes. And what I would tell you is where you've seen a lot of people doing quite well, and a lot of people in family office environments, right? So it's an intergenerational wealth. Someone has made a lot of money doing something. And because their default position is that they're quite wealthy, they're willing to take longer time horizon views on kind of what can be successful. And so their view is, look, if I have to, like as an example, if I make an investment and it takes me 10 years, if the compounded annual rate of return is, 0 for a long time, but then it takes off and it goes to 25 and my, from beginning to end is 15 or 20%, I'm happy to wait. The problem with that model when you're dealing with a pension fund is the pension fund has much nearer term needs. They have retirees who need money now. And so it's been a very tough market to convince we'll call it sort of a traditional LP base that this is a model that they should pursue. It's been much easier, I think, for people who have relationships with family offices and some of these sort of longer dated intergenerational wealth managers. What I think would be incredibly interesting is if we could build a model whereby it was available to the general public to do this sort of thing. And my coverage and I have spent a fair amount of time thinking about ideas like that.
In a way like an open-ended fund, like a mutual fund kind of approach, something else?
Yeah, I think one of the areas that we've been investigating and thinking about is, I'm going to give you just a quick thought experiment. I gave a speech at Stanford and tours a high net worth conference at Stanford in 2019, where a bunch of very wealthy, they're called ultra high net worth families come from, which each have a net worth of more than 30 million. And they said, we'd like you to come up with some ideas to think about how to invest in climate. And what I came up with was the idea that most families spend between about 1% and 3.5% of their annual net worth on insurance. So they're insuring, homes, cars, business interruption, catastrophic hurricanes, all sorts of things, because they have a lot of assets and they're wanting to make sure that they, if something bad happens, they can do that. So the idea that the thought exercise that we went through is we said, well, how many families are there globally? At that point, there were just about 400,000 families globally that have a net worth in excess of 39. And I said, how much capital would it take, equity capital, would it take to build enough direct air capture plants to get from the 420 parts per million that we're at today down to 180. How many physical plants would that take? And then based on the learnings that I amassed from my time at carbon engineering and at 1.5, we came up with that number. And then we said, if all of those 400,000 families were to effectively donate a percentage of their net worth on an annual basis for the next 30 years, because this was kind of 2020, to reach the 2050 target that you see people talking about a lot, what percentage of their net worth would they need to effectively self-tax themselves? And it turns out it's about 10 basis points. And a basis point, for folks who don't know, is there's 100 basis points in every 1%. So 10 basis points is effectively 0.1%. So if 0.1% of a percent of all net worth for the top 400,000 people globally was just, you did it every year on December 31st and got a tax deduction to do it, you'd have enough capital to build every direct air capture plant necessary to take us from 420 parts per million to 180. That's a model I think is interesting because it essentially says to people, you insure against all sorts of things. Isn't it worth some percentage of your net worth to insure, again, to future-proof the climate so that all of this wealth that you want to hand off to future generations allows them to live in a world in which things aren't completely out of control? It's an insurance-based argument, and I like it.
Have you socialized it much? Do people like it?
Yeah, I actually have, and I have 5 or 6 groups with whom I've done a lot of business who are sort of thinking of that. And I think it's I think it's also a product that potentially has a mass market reach. I mean, one of the ideas that I often think I learned not too long ago that Selena Gomez has 635 million followers on the internet.
Wow.
And I don't really know Selena Gomez well, when I've saw her on, whatever the thing, something in the building with Steve Martin there and Martin Sharp. But I've often thought to myself, what if all of these people who have all this social attention were to say to their audience, what if you guys all, to give you a sense of it again, Russ, if you have $100 million of net worth, I'm talking about $100,000 a year.
That's nothing.
It's literally, it's like people's portfolio, you got $100 million and you're growing it at 10% a year, you're making $10 million and you divide that by 365 days a year. Just the market movements are like an order of magnitude larger than what, it's literally a rounding error. But what if Selena Gomez got on her platform and said, I'm going to commit 10 basis points of my net worth and I invite you as all of my followers to participate. And I've also done that calculation, which is the median net worth in the United States is about $125,000. And there's about 40% of surveyed people in our country who say that they're deeply concerned about climate and would make a financial decision based on that idea. So that's like, 100 million people. 100 million people and $125,000 times 10 basis points. It's about $2.3 billion a year. So if you were to do that, you'd be the largest climate fund, by any measure. You would dwarf what Bill Gates and the guys at Breakthrough Energy Ventures are doing. Dwarf. So the idea is could you create something where the small retail participation rolled up into a larger entity and then directed at a perpetual climate problems is an interesting idea.
It is an interesting idea. It's also intriguing to me that you have highlighted DAC in this. Granted, you're a very long time direct air capture person, but why are you obsessed with direct air capture? Of all the different pathways now, seems like you're still thinking about direct air capture. You're still very much engrossed in it. Why DAC? One
simple reason. if we were to magically turn off all carbon emissions tomorrow, and again, I'm not going to do this in megatons, I'll do it in parts per million, because I think most people know about 420 parts per million.
I like that way too, personally.
Yeah, otherwise it gets a little arcane in the math because it's volumetric, the rest. But assuming that that's about 3 ppm per year, if we were to turn that off tomorrow morning, so it was zero carbon, which is where most of the capital has been invested the last 25 years, wind, solar, on-biz, all the rest, you still are, by any measure, 140 ppm QI. So really, and if you want to do 3 over 140, rough math is 97% of the carbon that's causing the problem is already out there. So it's a legacy problem. So we need to go back and pull out the carbon that is the legacy of 150 years. And even if we were to eliminate all the new carbon emissions, the inertia, like the physical inertia that's embedded in that 97% is going to make the problems that we're having today and that are accelerating continue for some indeterminate, depending on who you read, I think it's probably 100 years. So we have to be in the direct air capture business. It's not to say that there shouldn't be any other things, but we have to be in the direct air capture business, or we're not going to get we're not going to get to see the benefit that we're all hoping to get.
Relative to enhanced weathering or some of the other things that are happening in carbon removal, you're still so focused on direct air capture, it sounds like. That isn't a criticism either. I'm sure you have good reasons. I just want to hear more of them.
I think I believe in enhanced weathering. I believe in all of it. I'm very much in the all of the above, but I still believe that as a matter of efficiency, direct air capture plants are you could, 100 acres, you can take 1 million tons out per annum. I challenge you to make that equation work at any scale of that nature without land use, water use. There's a whole bunch of other things. I think I'll put it this way. We spent 100 years using mechanical and chemical engineering to get ourselves into the problem that we currently have. I believe that the way back out is with chemical and mechanical engineering. I believe that nature will fix the problem, but not in a time frame that will be acceptable to most people. Look, if you say I have 1,000 years to fix the problem, it's just let the trees dry. It's fine. But if you're worried about 50 to 100 years, you need a chemical and mechanical solution, and that is the best. Parenthetically, I follow very closely what David Keith and the guys in geoengineering and aerosol, stratospheric aerosol injections. I very much believe that probably will be used. And I think of that as the Tylenol of climate change, which is we're probably going to have to take some Tylenol to keep the fever down, but we're going to have to continue to use direct air capture and other mechanisms to reduce the CO2 over time. And maybe to bring it all the way back to where we started. And I think that the financial mechanism to make that latter piece work is much closer to a perpetual capital model than it is a 2 and 20 closed 10-year fund.
Can you explain more what a perpetual capital model is? I think that's probably also a new term.
Yeah. A perpetual capital model is pretty simple. And it's the way that like a family would operate, right? Which are an intergenerational family. So it simply says, as I make profits, I simply just continuously roll them back into the vehicle to make more and more investments. So, give you an example. Like, let's say, I'm the patriarch of a family and I buy a building, right? Well, when the debt pays down on that building and I have lots of free cash flow, if I have a perpetual view on real estate, I just buy another building, and I never sell the buildings. And if you look at how, like as an example, some of the biggest real estate empires in the world have been built, is that the family just, when interest rates go down, they refinance the building, they buy another building, and they just keep building forever. I believe that that's the model that will have to be used for direct air capture assets and other carbon removal assets and the technologies that go into them. Because we have to look at this as if this is a 100-year problem, And we need to have 100-year or longer time horizon in terms of how we allocate capital and how we measure progress, right? That as long as we're making progress and it's still profitable and moving the ball forward, then effectively there's no distribution. We're just going to grow forever, right? And that, if you look at the way that, if you want to think of, I think of carbon assets as a form of national wealth or of global wealth. If we want to build the global wealth of carbon removal, we need to view it as if it's not just a one and done thing, which is, CalPERS puts in their money, we take it out, and then they go allocate it to something else. We say, no, everybody who's invested in this is simply saying, I'm going to keep my capital in this lane forever. Right? And that's why a smaller amount is important, because you would never say to someone who's reasonable, hey, give me 10% of your net worth, and I'm going to put it in something you can never take out because you might need the money. But if you get a large enough group of people with a small enough commitment, that equals a large number. And then once that number is into that mode, it compounds and grows in perpetuity. And that, in my opinion, is how we're going to generate enough carbon wealth, carbon removal wealth, to just, I see a world when I'm long gone where there's thousands of carbon assets removing carbon in all forms, but they're owned effectively for the public good in perpetual trust. And by the way, there are examples in the trust. I mean, you have families in England and people have set up perpetual trust for the benefit of the family. I'm just saying, let's port that model for think of like the family that is everybody, like the whole world.
This episode is brought to you by Netflix. 3 couples, 4 vacations, a lot to unpack. Watch The 4 Seasons, a new series starring comedy favorites Tina Fey, Steve Carell, Will Forte, Coleman Domingo, and more in a hilarious and heartfelt love letter to long-term relationships. Based on the original Alan Alda film. Watch The 4 Seasons, streaming now only on Netflix.
Morning decisions. A creamy mocha frappuccino drink? A sweet vanilla? Maybe a smooth caramel? Or that white chocolate mocha? Whichever you choose, delicious coffee awaits. Start your day with bottled Starbucks Frappuccino drinks. Pick up a bottle near you wherever you buy your groceries.
Interesting. Well, I hope that works. It would certainly be better than the pressures that one faces when one takes venture dollars. I have a question about the future of DAC. One of the old fights I used to hear a lot about, I hear less about it these days. I wonder if it's been settled and maybe I missed it. But do you suspect that the future of direct air capture is distributed or centralized?
Centralized.
Centralized. I sort of figured you probably went that way, the oil and gas angle.
Big is beautiful. Big is beautiful. Now, I will say, I think that the construction of those centralized plants is modular. Manufactured, not state-built. So small is beautiful in terms of the building blocks, but the actual configuration of the plants largely is much different. And that's just, it's like basic unit economics, because if I can centralize all of that collection in a single spot, the shared services, whatever they are, the electricity, the water, all the rest of that, are better distributed across 200 than say 20. But the manufacturing will be modular. And in that respect, small will be beautiful.
What do you think will happen in the fight between electrochemistry, liquid and solid sorbents? What broad pathways here do you think are going to be the big winners?
I think... Okay, so I obviously believe in liquid sorbents. I think what I say is all of them have their limitations. I think some of the limitations are greater limitations than others. I believe in liquid sorbent, but I believe that one of the great rate limiters will be how water is consumed and air produced or used in process. So I think one of the great rate limiters potentially of liquid sorbents is the amount of consumption of water. People are working on that. Ox is definitely working on that. I think solid sorbents are interesting, but require a considerable amount of heat. People are working on that. I'm talking my own book here. I very much believe in moisture swing. We're investors in, very early investors in a company called Avnos that basically produces water as a byproduct of its direct air capture of consumption. And I think that there are limited places where electrochemistry will work. I will tell you that we, having built what is and invested in creating, is now the first or second largest desal company, membrane company in the world. I have real questions about ocean-based stuff, not because of the electrochemistry, but because of the amount of physical water that needs to be moved. Again, electrochemistry works for sure. So that's a long-winded answer, but I think all of them work. All of them have distinct limitations. I think water and electricity consumption are the two big ones. They're probably the most problematic. So I think it's probably like carbon and moisture swing. If you put a gun in my head, those would be my two. Those are my two bets. So
Yeah,
we'll see.
If someone was listening and they work at a family office or they're part of a family that has intergenerational wealth in this way, do you want them to get in touch with you? Are you ready for them to knock on your door?
Absolutely. Jim.McDermott at Rusheen.com. It's JIM.MCDERMOTT at RUSHEEN. I'm very interested in those types of conversations if people want to have them.
Thank you for being here, Jim. I love being able to ask all these questions of you. You held your own. Thanks for teaching me all of those things.
Thanks a bunch for having me, Russ. I really appreciate it.